Are you wondering what the future holds for commercial real estate finance? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In an era marked by economic fluctuations and geopolitical uncertainties, the commercial real estate sector is navigating a landscape filled with both cautious optimism and persistent challenges. According to Dean Delchinos, who is the head of real estate credit at ORIX Corporation USA, the current focus in 2025 involves adapting to the evolving lending trends and the significant role of private lenders. In a recent interview, Delchinos highlighted the ongoing concerns surrounding interest rate volatility and how both banks and non-bank lenders are adjusting to these changes, especially in light of geopolitical tensions and legacy debt issues. Delchinos provides a comprehensive overview of the current state of commercial real estate lending, emphasizing the identification of attractive property types and strategies for mitigating risks in transitional assets. The conversation sheds light on the trajectory of the lending market and offers insights into future directions, with a particular focus on how lenders are navigating the complexities of 2025. The interview underscores the importance of staying informed and adaptable in the face of an ever-changing financial environment. In an era where traditional retail real estate struggles to adapt to shifting consumer behaviors, Four Corners Property Trust, known as FCPT, has carved out a compelling niche by targeting high-traffic retail corridors with triple net leased properties in resilient sectors. As of July 2025, FCPT's portfolio spans 1,198 properties across 47 states, with a 99.6% occupancy rate and an average lease term of 7.3 years. This article evaluates FCPT's strategic expansion into sectors like full-service dining, healthcare, and automotive services, analyzing the long-term value proposition and risk-adjusted returns for investors. FCPT's focus on sectors with inherent demand stability, such as healthcare, essential dining, and automotive services, positions it to weather economic volatility. For example, the United States full-service restaurants market is projected to grow at a 10.23% compound annual growth rate through 2033, driven by consumers seeking curated experiences. FCPT's acquisitions of Longhorn Steakhouse and Cheddar's Scratch Kitchen properties align with this trend, leveraging corporate-backed tenants to mitigate operational risks. Similarly, its Novant Health urgent care properties benefit from an aging population and the shift toward outpatient care, a sector expected to grow as healthcare costs rise. The Real Estate Investment Trust's expansion into automotive services, including Tires Plus and Christian Brothers automotive locations, taps into another recession-resistant sector. Vehicle ownership rates and repair demand remain steady, with FCPT's 20-year leases on VIVE collision properties providing long-term cash flow visibility. These sectors, combined with FCPT's triple net lease structure, which transfers property taxes, insurance, and maintenance costs to tenants, reduce the Real Estate Investment Trust's operational exposure while ensuring predictable income streams. FCPT's disciplined approach to capital allocation is evident in its recent transactions. In the second quarter of 2025 alone, the company acquired $14.7 million in Cheddar's Scratch Kitchen properties and $12 million in Novant Health urgent care locations, all priced at cap rates within its target range of 6.2% to 6.8%. This consistency in valuation ensures that FCPT avoids overpaying for assets, a critical factor in maintaining risk-adjusted returns. The Real Estate Investment Trust's liquidity further strengthens its strategic flexibility. As of July 2025, FCPT holds $617 million in liquidity and a $350 million revolving credit facility, enabling it to capitalize on acquisition opportunities while maintaining a conservative net debt-to-adjusted EBITDA ratio of 5.4 times. This financial resilience is particularly valuable in a market where interest rate volatility could strain tenants with maturing debt. FCPT's long-term leases, averaging 11.9 years, provide insulation against refinancing challenges, ensuring stable cash flows even as broader market conditions fluctuate. While FCPT's strategy is robust, several risks warrant attention. Labor and wage inflation in the restaurant sector could pressure tenants like Longhorn Steakhouse, potentially impacting their ability to meet lease obligations. However, FCPT's focus on corporate-backed operators reduces this risk. Similarly, regulatory shifts in healthcare, such as Medicare Advantage rate adjustments, could affect Novant Health's margins. Yet, FCPT's triple net structure and long-term leases provide a buffer against short-term margin compression. Interest rate volatility remains a macroeconomic headwind. While the Federal Reserve's rate cuts in late 2024 have eased some pressures, rising rates could strain tenants with near-term debt maturities. FCPT's extended lease terms and diversified tenant base mitigate this risk, as do its proactive refinancing efforts, including a $225 million term loan extension in 2025. Geographic diversification also plays a key role in risk management. FCPT's properties are concentrated in markets with strong retail corridors, such as Florida, Georgia, and Michigan, which benefit from tourism and suburban migration. This reduces exposure to regional downturns while leveraging the 15% year-over-year foot traffic growth in suburban retail, as reported by PwC. FCPT's strategy offers a compelling case for income-focused investors seeking exposure to resilient sectors. Its 7.1% initial weighted average cash yield, coupled with a 99.5% rent collection rate, underscores its ability to generate stable returns. However, investors must weigh these benefits against sector-specific risks, such as labor costs in dining or regulatory shifts in healthcare. For those with a medium-term horizon, FCPT's disciplined capital allocation and focus on long-term leases make it an attractive option. The Real Estate Investment Trust's recent ATM program, which raised $149 million in the first quarter of 2025, further demonstrates its ability to fund growth without over-leveraging. Investors should monitor FCPT's tenant credit quality and sector trends, particularly in the restaurant space, where bifurcation between premium and mid-tier brands could impact performance. FCPT's strategic expansion into high-traffic retail real estate is a testament to the evolving retail landscape. By targeting sectors with durable demand and leveraging triple net leases, the Real Estate Investment Trust has positioned itself to deliver long-term value while managing risks through diversification and financial discipline. For investors, FCPT represents a balanced opportunity to capitalize on resilient consumer trends, provided they remain mindful of sector-specific headwinds and macroeconomic shifts. As the retail real estate market continues to adapt, FCPT's focus on quality tenants and prime locations offers a compelling roadmap for risk-adjusted returns. New York-based developer and commercial real estate investor Rabina has successfully signed the first 3 office tenants at its new Skyscraper located at 520 Fifth Avenue in Manhattan. This Class A tower stands at an impressive 1,002 feet and is set to be the tallest mixed-use building on Fifth Avenue when it opens this fall. The tenants will occupy nearly 29,000 square feet of the available office space. The inaugural tenants include Ancient, a private equity investment firm based in New York City, JAB Holding Company, a global investment firm, and an unnamed biotechnology hedge fund also based in New York City. These firms are expected to move into the building by the end of the year, as stated by a spokesperson from Rabina to Commercial Property Executive. Ancient will relocate from its current office on West 22nd Street to occupy 8,682 square feet on the 14th floor. JAB Holding Company will move to the 11th floor, taking up 11,634 square feet, while the biotechnology hedge fund will establish its headquarters on the 23rd floor, occupying about 6,800 square feet. The brokerage teams involved include CBRE and JLL, with specific brokers facilitating each deal. The building at 520 Fifth Avenue features boutique luxury offices over 25 full floors, each offering spaces ranging from 6,800 to 12,300 square feet. The design incorporates 12-foot-plus ceilings, private terraces, and operable windows that enhance natural light and air circulation. The location is prime, sitting at the intersection of Fifth Avenue and West 43rd Street, near Bryant Park and Grand Central Station. The architectural design of the building is inspired by Beaux Art style, crafted by Cone Peterson Fox, with interiors designed by Charles & Co. Residential sales at the building were launched in April 2024, with more than 95% of the 100 luxury residences already sold, highlighting the strong demand in the market. Manhattan's office market has shown robust performance with net office absorption exceeding 3 million square feet so far this year, and a decrease in total availability to 15.3%, reflecting a 300 basis point drop compared to last year. Leasing activity remains strong, with over 1 million square feet leased in May alone, indicating a healthy demand for office space in the area. The former Tampa Bay Times printing plant in St. Petersburg is set to be transformed into a 392-unit apartment complex. This redevelopment project marks a significant change for the site, which has been a notable part of the city's landscape. The real estate firm behind this initiative aims to revitalize the area, contributing to the growing demand for multifamily housing in the region. This development is in line with the ongoing trend of converting underutilized commercial spaces into residential properties, a move that aligns with the shifting needs of urban populations. This project is particularly relevant when considering similar trends in cities like Kitchener-Waterloo, Cambridge, and London in Ontario, where the demand for multifamily housing has also been on the rise. These areas are witnessing a transformation of former industrial and commercial sites into residential complexes, catering to a growing population seeking convenient urban living spaces. The cross-border relevance of this trend highlights the global shift towards maximizing urban land use efficiency. In the United States, the repurposing of commercial properties into multifamily units reflects a broader strategy to adapt to changing demographics and housing demands. Developers are increasingly focusing on creating vibrant, mixed-use communities that offer residential, retail, and office spaces in close proximity. This approach not only addresses housing shortages, but also stimulates local economies by attracting new residents and businesses. The transformation of the Tampa Bay Times printing plant into a residential complex is expected to enhance the neighborhood's appeal and increase property values. It also aligns with efforts to rejuvenate urban areas by introducing more housing options that cater to diverse socioeconomic groups. As cities continue to evolve, such projects underscore the importance of adaptive reuse in urban planning and development strategies. In recent news, Chase Properties, a company based in Beechwood, Ohio, has made a significant acquisition in the retail sector. They've purchased a portfolio totaling 514,983 square feet across multiple shopping centers located in Texas and Arkansas. This acquisition includes notable properties like South Loop Crossing in Lufkin, Texas, and Killeen Marketplace in Killeen, Texas, as well as South Center Shopping Center in Hot Springs, Arkansas, and Massard Crossing in Fort Smith, Arkansas. Notable tenants at these locations include well-known names such as Ross Dress for Less, Best Buy, TJ, Max, Kroger, and Hobby Lobby. This transaction marks Chase Properties' entry into both Texas and Arkansas, expanding their footprint in the retail real estate market. The acquisition by Chase Properties highlights a strategic move to strengthen their position in the retail sector by targeting regions with robust economic activity. By entering the Texas and Arkansas markets, Chase Properties aims to leverage the growing consumer demand in these areas. This acquisition aligns with broader trends in the retail real estate industry, where firms are seeking to enhance their portfolios through strategic purchases in high-traffic locations. With this acquisition, Chase Properties is not only expanding its geographic reach, but also diversifying its tenant base. The inclusion of major retail brands in their portfolio indicates a focus on securing stable, long-term income streams. The presence of popular retailers like Best Buy and Kroger ensures a steady flow of foot traffic, which is crucial for maintaining the vitality and appeal of these shopping centers. In the context of the Canadian market, particularly in regions like Kitchener-Waterloo, London, and Cambridge, Ontario, similar strategies are being observed. Developers and investors are increasingly focusing on retail centers that offer a mix of essential services and popular retail brands. This approach not only caters to local consumer needs, but also attracts a diverse tenant mix that can weather economic fluctuations. The cross-border relevance of these strategies underscores the universal principles of retail real estate investment that prioritize location, tenant diversity, and consumer accessibility. As we continue to observe these trends, it's evident that the retail real estate market is adapting to the evolving demands of consumers. The emphasis on strategic acquisitions and tenant diversity is a testament to the industry's resilience and its ability to navigate the challenges presented by economic uncertainties. Chase Properties' recent acquisition is a clear example of how real estate firms are positioning themselves for long-term success in the retail sector. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.